Hello and welcome to the latest episode of Mayor Brown's video series at the Crossroads, CFTC and DOJ Enforcement. My name's Matt Kluchenek, a member of Mayor Brown's Litigation and Dispute Resolution Group, and I'm joined today again by my partner, Glen Kopp, former federal prosecutor out of the Southern District of New York and a member of Mayor Brown's white collar and government enforcement practices. As you may know, each week, our goal is to bring to you an interesting and timely CFTC and Department of Justice topic. And today we're going to provide you with an overview of the disruptive trading and spoofing prohibitions. And for the next several weeks, we're going to focus on topics, on various topics relevant to that area. We'll talk a little bit about defenses. We'll talk about claims, allegations, the DOJ space, the various equity and commodity spaces in terms of what we're seeing, and we'll get into a fair amount of detail. But today, just an overview, and thanks to everyone for joining us. Glenn?
Good afternoon, Matt. Good to see you again. So, Matt, why don't you, if you could, start us off with a bit of a history lesson and take us back to a significant year being 2010. What happened there of note?
Sure. Just a very, very brief history lesson. So go back to July 2010. That, of course, was the passage of the Dodd-Frank Act. And in Title VII of the Dodd-Frank Act, Congress added a provision for C-85, which was is the disruptive trading provision. And that provision includes, among other things, what we now refer to as the anti-spoofing prohibition. Essentially, it says that it is prohibited practice. It's illegal to engage in spoofing, which is the placement of an order with the intent to cancel it prior to execution. And so that was 2010 pronouncement by Congress. Importantly, as many of us know, with respect to the Dodd-Frank Act, a lot of authority was given to the CFTC as well as the SEC to flesh out the various prohibitions, and the CFTC certainly did so with respect to spoofing. It wasn't until 2013 when the CFTC issued some guidance, discussed what spoofing is not. While it provided some clarity on a few issues, also created a real lack of clarity on a number of issues and some confusion. And then shortly thereafter, CME Group became the first market to issue an anti-spoofing prohibition rule, which is Rule 575, as well as an FAQ that went through various scenarios about what's permissible, what's not permissible in the context of spoofing, and more broadly that of disruptive trading.
Matt, if you could, let's focus on spoofing. Could you describe what is the sort of paradigmatic spoofing case or activity, if there is such a thing?
Sure, Glenn. So there's really a couple or a few different paradigms that we've seen in our representations and with respect to consent orders and convictions and so on and so forth. And so as a general matter, if a trader places an order with the intent to cancel it prior to consummation, that is spoofing, as long as that intent is present. But where we've seen regulators, authorities focus even more is this paradigm that really couples spoofing along with manipulation of the market. And so it'd be a situation, for example, let's say a trader wants to buy 10 gold futures contracts. And that's the genuine interest of the trader. So trader puts in an order to buy 10 contracts of gold futures. That order is resting, no movement, hasn't been filled. And so let's say the trader puts in an order on the other side of the market to sell, and for example, to sell 500 gold futures contracts. And so that order ostensibly is large relative to market depth in the order. When we say market depth, we're talking about the contracts and the orders on both sides of the market, really the liquidity of a particular market. So the trader has a 10 lot, the trader wants to be filled on, it's resting, enters an order on the other side of the market, inordinately large, say 500 contracts. The purpose, again, ostensibly of placing that alleged spoofed order on the other side of the market is to telegraph, signal to the market that there's selling pressure in our example here. And so in theory, one would expect prices to fall, and then there'd be a fill of the genuine order, that 10 lot. And as soon as that fill happens, there's almost immediately, by immediately, it might be milliseconds, seconds, sometimes minutes, a cancellation of that alleged spoofed order. After all, under this paradigm, the trader never wanted to get filled on that large order. And so that scenario is the one we see most commonly brought by authorities and regulators, both as a violation of the spoofing prohibition, as well as a form of price or market manipulation.
And Matt, are there other types of disruptive trading practices that are a focus of the CFTC other than just spoofing?
Sure, not just the CFTC, but also the SEC, FINRA, the markets, absolutely the case. And so different types of practices such as layering, where you basically have spoofs on top of spoofs, and variations to the general theme I mentioned. You can have something called flickering, where you place an order, and often it's an algorithm and it just keeps flickering orders on and on and on and on. That can be both spoofing as well as a form of disruption. You can have a rogue algo. This happens from time to time, and we've seen this with respect to a number of civil cases where it fires orders, and again, the intention wasn't there for it to be executed. Question as to whether some of these are actually spoofing or manipulation or just disruption. It might fall into one or more of those buckets, but what we're seeing increasingly over the past couple of years is the envelope being pushed in terms of types of practices that might be prohibited.
And Matt, I think you've mentioned sort of, I think, precious metals. Where are the markets that the regulators are looking at for this kind of misconduct, or where are they finding it the most in your experience?
You know, I would say a good question, Glenn. I really think the regulators, for the most part, are agnostic to the market, and they look at lots of different markets. But the most focus has probably been in the precious metals market, certainly with respect to the Department of Justice and its many cases, indictments. We also see a lot of activity with respect to rates and treasuries, in terms of cases being brought by the exchanges, the CFTC, as well as the DOJ, but other markets as well, the ag markets, the energy markets, certain other markets. So it kind of equal opportunity in that respect.
Fair enough. And Matt, is there something that you would highlight for our viewers in terms of what are the takeaways? What should they take with them from this sort of history, this brief history lesson?
Sure. And we're gonna cover a number of takeaways in additional sessions where we talk about spoofing, disruptive trading in particular. But I think, clear takeaways would be that, spoofing came roaring onto the scene in earnest probably 5 or 6 years ago. I think many thought that there would have been significant abatement by now, but we're still seeing a lot of activity in the markets generally. So traders ostensibly engaging in this type of conduct, as well as a lot of cases. And these types of cases, whether it's criminal, whether it's on the equity side, whether it's on the commodity side, just keep coming fast and furiously. We're also continuing to see a lot of focus on both firms as well as individuals being held accountable. This is a space where the regulators have really, for the most part, sought to hold each accountable, whether it's the firm or the individual. There's been some exceptions, but those are, tend to be fact and circumstance based. In closing, Glenn, quick question for you. Can you give us a preview with respect to the criminal space? And we're of course going to devote a session to that, a few sessions, but any highlights you'd want to talk about, Glenn?
Sure, Matt. I think, the key here is that spoofing has been criminalized. And so under certain circumstances, and we've seen a number of them over the last sort of 5 years or so, but a real ramping up of intensity starting in early 2018, is that DOJ will prosecute spoofing cases criminally when they can, they are comfortable making those kinds of cases. It's only, again, it's a relatively new criminal law, and so it's taken DOJ some time to get familiar with the space, but I think they've got their sea legs under them, and they will continue to bring cases against individuals. They will continue to seek remedies against their employers through whether it's criminal prosecution, but oftentimes we see deferred prosecution agreements or other types of agreements with the companies in this space. And I think we'll continue to see that, where it's not only it's sort of combination of, or the kind of cases that we'll continue to see brought are those where you've got spoofing conduct tied along with evidence of knowledge of the wrongdoing, and that will usually be in the form of some sort of communications by the offenders.
Great. Okay. Thanks, Glenn. Much more to follow on that topic in particular, and a bunch of other topics related to spoofing. Thanks to everyone for watching today. We look forward to seeing you next week. Thanks.
Take care.